Hi, good afternoon, and welcome to Tobias Financial Advisors second quarter market update here. I am setting up my screen here for sharing our presentation today, and I will be starting in just one moment, so bear with us, and we will get started in just one moment. Hopefully everyone's seeing our title screen here today, so let's jump right into it. As we begin here, we want to just make sure that we are letting everyone know that this is a educational session, general in nature, and any information you see here or learn about, we discuss here today is more for a general consumption, and that anything that we discuss should be run by your Tobias Financial advisor, so that you can understand how the themes that we're discussing here in the markets affect your personal situation. And so please encourage you to speak to your Tobias Financial advisor. A little about who we are. We are, of course, founded in 1980 here in Plantation, Florida. Currently, we are a team of about 15 financial professionals, and we manage over $500 million for small business owners, retirees, professors, all sorts of walks of life, and also some small businesses. So we have some great team members on board. We have a chartered financial analyst like myself, and some CPAs, as well as certified financial planners, CFPs. And allow me to introduce myself. My name is Matt Sainholtz. I am President and Chief Investment Officer here at Tobias Financial Advisors. Just a little bit on our general themes, what we're trying to do for our clients. We want to make a portfolio that is for you. I mean, after all, money is a tool to achieve the lives that you want to live. So what we are trying to do with the portfolios we manage is create an investment plan that has a good, proper trade-off between your needs and the risk you're willing to take in the portfolio. And usually that is a combination of how much stock or equity we're going to invest in the portfolio versus bonds or fixed income. We're going to structure the portfolio around dimensions of returns, meaning are we going to be investing in small companies, large companies, as far as bonds are concerned, maybe government bonds or safer bonds or different types of businesses. That all leads to diversifying broadly and just having an overall diversified approach. We want to keep in mind that we want to reduce our expenses and our turnover. It's not, you can have a great investment strategy, but it could be expensive. There could be a lot of turnover that could cause taxes for you. So being rooted as a financial planning and coming out of the kind of being born out of an accounting practice, we definitely want to focus on taxes and minimizing taxes and really going for total return when we look at people's portfolios. All right, so today's agenda is really want to just review the last quarter's performance. We want to talk about different market events, and wanted to then dive into some of the questions that we're hearing in our meetings on a frequent basis. What is the economic outlook for the remainder of the year? The Biden infrastructure plan, what is it? What does that affect? How could it affect us? Interest rates are really low. How do we think about the bonds in the portfolio, and what do we do about low interest rates? And then we'll be giving some general guidance on outlook and for 2021. So here is the results from the last quarter market summary. U.S. stock markets up 6% in the first quarter. A lot of portfolios, if we were up 6 to 10% for the year, we would call it a year and have a great year. So the stock market is continuing to run having a great first quarter with the S&P 500, a measure of the bigger companies in the US stock market, up 6%. And then across the globe, from international developed countries, emerging market countries, and real estate, all showing positive returns in the first quarter, the first 3 months of 2021. So we do see some red arrows on this chart, which signifies downward performance in the market, and that is coming from the bond market, the fixed income side of the portfolio, the bonds, U.S. bond market, which is of course, a composite or an index of all the different types of bonds in the U.S. We're down about 3%. And global bonds were down about -2%. We're going to dive into what that means and how that came to be. But for the first quarter of 2021, we've had a positive stock market performance, but negative bond market performance. Here's a kind of a chart of the last 12 months, and wow, what a 12 months it's been for all of us as investors and humans of the world. It has been over last March 23rd was actually the bottom of the S&P 500. That marked the bottom of the bear market that actually started in February. One of the shortest bear markets of all time, starting in February 20 and ending in around March 23rd, 2020. So it was a very short duration bear market, but it was very scary because the drop, how fast it dropped. It dropped from just in that month time period or so, the S&P 500 dropped about 34% in that time frame. But the good news is the last 12 months, we haven't looked back, in that we attribute that to a lot of things that have happened, mostly monetary policy, having low interest rates, having big government stimulus packages passed throughout, and the fact that COVID-19, although I'm sure it affects our lives on a daily basis, and maybe folks in your lives it has affected very drastically, but the economy and the disease has had positive news in the form of vaccinations, and the fact that we are kind of continuing to come out of a very nasty recession. And so the past 12 months, we've seen some remarkable performance, up over 50% from where we were last March, and we are reaching new highs from this time period. We have the Dow continuing to close at new highs, and we can talk about the different types of kind of the sectors of the market on what's been performing well and what's been kind of been lagging behind. So to that, we have this performance chart here regarding the U.S. stocks in the first quarter of 2021. These are the ranked returns of different types of the market. Overall, the market did about 6%, a little over 6% market-wide in the U.S. in the first quarter. However, small companies were really outperforming the larger companies in this time period. Small value stocks returned over 20% in this time frame, whereas small caps in general are about 12% returns, whereas large company stocks were more around the 6%. So what happened, or what can we glean from that, or kind of just give us a replay of what outperformed and what didn't? So when you think back to really the pandemic and the COVID crisis, it was scary. So a lot of the returns were big companies. A lot of investors rushed towards the more perceived and probably the more stability of larger companies. We're talking about Apple. We're talking about the big companies in the United States, Johnson & Johnson, JP Morgan. These big blue chips were kind of a safety factor, on top of the fact that the world was transitioning to the stay-at-home. Growth companies, which are more kind of technology based for the most part, consumer telecommunications. Again, this kind of shift to work from home was very popular during the COVID. The worst at stay-at-home. And so those large companies and large growth companies in particular were kind of the leaders last year in as far as performance. However, starting around probably say December or November of 2020, after the Biden election, and it looked like the vaccinations were starting to come out and the economy started to pick up, we've seen a great rotation and out of kind of large companies and growth companies into the smaller companies, into the more value companies. So we saw that in the first quarter, and we do think that that has some legs as far as what's going to happen in the year ahead, where we might see some of the smaller companies continue to outperform and the value companies outperform the larger cap growth companies based upon where they're valued today and just where we're seeing the economy moving forward throughout the rest of 2021. This is a little about global market equity returns for the first quarter and last year, 2020. I would like to show this chart because the top right here, the pie chart, where 50% of the world's stock market capitalization is headquartered here in the United States. So if you really have a home bias towards the United States, you're giving up about 40% of companies that are headquartered worldwide. So here at Tobias Financial Advisors, we do really believe in a globally diversified approach and having your allocation mixed around the globe. So when we're looking at year to date, Europe and local US dollar currency, S&P 500 have led the charge at 6% returns. Over the last 15 years, the US has led the charge. If you look at kind of the long-term numbers, we're almost at 10% annualized over the last 15 years compared to the rest of the world. I love the United States just as much as anyone, but there might be a reversion to the mean, and the fact that we might see some outperformance from the international and kind of have the pendulum kind of swing back once we get out of the COVID crisis, knowing that we do have an administration in the office that may be a little more friendly towards freer trade globally and maybe not as many tariffs globally. So we kind of might see some growth catch up from international stocks as well. And if you're looking in the bottom right here, the cyclical sectors versus technology, again, I was kind of mentioning how last year was kind of a story of technology, work at home. That has heavy weight towards the US versus the world, whereas 27% of the US has more technology, whereas if you're looking at the world, only 13% of that has kind of in the technology sector. The rest of the world is more cyclical. So more cyclical stocks come into play when the economics, the economy is growing, the world economy is getting back online. So that'll be something that we'll be looking out for towards the next 12 months as far as investing is concerned. So what about the economic outlook? What are we looking for as far as 2021? What could be some headwinds? What could be some possible tailwinds? Well, it really comes down to what the world is going to look like as we're moving towards getting back online. Here in the United States, we have a lot of different statistics out there. This is from JP Morgan as of March 31st. We've had, about the progress to herd immunity. There's different forecasts out there, but by the summer, if everyone that is eligible to take a shot and would like to take the shot gets the shot, we would be looking at potential herd immunity by this summer. Just anecdotally, I know that I'm safe as possible, but we do, going to Publix, our grocery store here, or there's some local trips out, maintaining social distance, of course. We're seeing more and more people out there. So the vaccinations seem to be working, as fatalities have come drastically down throughout the United States, and we are seeing fatalities come down. And so we have a optimism that as people continue to get vaccinated, we'll see the fatalities decrease, the cases decrease, and we'll return to some sense of normalcy in the economy and in the world. Prior to COVID, really, this blue, this is a chart of the GDP, gross domestic product, a measure of economic growth. The trend line was 2.5% going forward before the COVID crisis. And you can see, obviously, we had a tremendous recession, and just kind of now we're on the V-shaped recovery. So what we're expecting could possibly be in the neighborhood of 6 or 8% U.S. economic growth in the year of 2021. When we've been chugging along at 2%, and we put up the economy puts up a number of 6 to 8%, that is significant. And as a reminder, what kind of drives the domestic product or the economy, 2/3 of the economic growth is driven by consumption. We also have 18% government spending and then 14% investment. But that 2/3 of the GDP is based upon consumption. Well, that goes into the story of stimulus and having, we've had 3 stimulus checks passed out to the citizens of the United States for those that qualify. So getting that money into the pockets of people that are going to consume has been the major driver of the economic recovery, and what's really been driving the stock market as well. If you remember, as you recall, the stock market is really kind of a discounted mechanism of what's going to happen to all these companies that are on the stock market over the 6 months to the next 9 months or 12 months. So the pricing and how to price the stock market is based upon that we're going to have really good GDP growth. We're really going to have a return to somewhat normalcy in the economy, and that's driven by the stimulus, and that's driven by low interest rates. So those combinations together, we're expecting a really good year in the economics outlook to see the economy keep chugging along. Won't spend too much time on this slide, but this is with the data, economic data is typically lagging. It's typically kind of a month or so behind. So what the Federal Reserve came up with was kind of some different metrics to kind of see real time. They call it high frequency data, more real time information to give us a really better sense of what's happening in the economy. If you go back to March of last year, 1 year ago, U.S. seated diners was down about 100%. Everything shut down. Restaurants across the nation shut down. No one was going out to dinner anymore. So we had a tremendous drop in people going out to dinner. Fast forward to today, it's only down about 25% from its peak, from where it was prior to COVID. So you're starting to see anecdotal evidence of people getting back out there. Transportation, air traffic, passengers on the airlines have continued to increase. Where we're above is the mortgage applications, consumer and debit credit card transactions. People are spending a little extra money in their pockets. It's helpful, but people have been cooped up for a year, so that's going to be some even more pent up demand when people are still feeling vaccinated and or not, but just feeling more safe, and when they are out traveling and going out to restaurants and getting back out to the economy. So the overall economic outlook is good. We feel it's positive. We feel that it's going to continue to grow, and that would be a kind of a continued tailwind to the U.S. stock markets for kind of a continued positive returns into the future. So also, we're hearing a lot about the Biden infrastructure plan. This is a really extraordinary plan where we have over a $2 trillion plan in front of Congress, and that's being negotiated in Washington, on top of the stimulus that we've already given through the CARES Act and some other acts that have already been passed. This particular plan may not have a direct approach to putting money in the pockets. We might not have the direct stimulus to the end clients or our citizens, but the idea here is to kind of upgrade in various fashions and components, spending $2 trillion over the course of 15 years to really beef up this transportation infrastructure. This is your traditional bridges, roads, but also in this plan is also a lot of new ideas, which are electric vehicles. I heard that they may try to push something where all the school buses across America will be electric vehicles at within some time frame. So our big push towards electric vehicles and kind of your traditional things about infrastructure and upgrading airports and so on and so forth. Quality of life at home. This might be affordable housing, $650 billion on like affordable housing, school construction, and some of other opportunities where we are kind of helping people in their home life. And in addition to that, there's actually $400 billion to caregivers, where there could possibly be some support given to the elderly, disabled students, and a lot of, not getting political here, that may not be the Republicans' definition of infrastructure spending. So there's still a lot to be worked out with this plan, in addition to $480 billion for improving factories and different types of research to make some innovation when it comes to infrastructure and the kind of going green approach to climate control. So it is a big number, and it's definitely not passed yet, but these are the types of things that are getting pushed out there, and we will see what happens. This would be, of course, good for the economy. If we're going to keep spending, we're going to keep spending and keep putting money into the economy, put people to work. This is a big plan to upgrade America and get us all back to work. However, you can't just keep printing money, can we? We will have to pay for it in some fashion. One of the ideas is to increase the corporate tax rate, which was actually just lowered from when Donald Trump was in charge, from the more Republican, when the corporate tax rate was brought down across the globe. And so, made doing business here in America more attractive. And so if we raise our corporate tax rate back up to help pay for this plan, that may be another reason to favor international investing, international stocks as well. Again, if the people, corporations are smart, just like if you had a chance to reduce your tax rate, corporations may try to do that as well by keeping money offshore or just building their headquarters in different locations other than what could potentially be one of the highest corporate tax rate structures across the globe in the world. So again, nothing set in stone yet, but this is something that we're definitely keeping an eye on. If there's a fine balance of raising taxes to help pay for definite social need where we need to, versus raising taxes so high where people do not want to continue to invest. There's a lot of different things being floated out there, from changes in the estate tax laws to income tax laws. So we will, as your financial planning team, we're going to be staying at top of that, and be sure to speak to your Tobias financial advisor, a representative, about your personal tax situation when and if one of these tax plans and corporate tax increases do come into play. Interest rates are low. What is the role of bonds in the portfolio? Let me just show a chart. I think a picture's worth 1,000 words. So if you could see this light purple chart, this is in August of 2020. What you're looking at is called the yield curve. This is what bonds pay for the US Treasury bonds pay as far as yield in different time frames. So as of August 2020, a 10-year Treasury bond would pay you 0.5%, whereas now, just fast forward to March 31st, 2021, that 10-year is around, it was at 1.74. It's kind of down to 1.6 today as I speak, but we've had a tremendous rise in interest rates. Interest rates are vice versa. So when interest rates are rising, the value of your bond is actually decreasing. It's an inverse relationship. So that's why at the beginning of our session here today, we saw stocks were up 6%, but bonds were actually down 3% as a measure of the global, or the U.S. bonds, and even global bonds were both down. So that's as a result of interest rates going up. put it to go kind of more into the numbers here. I'm not going to go, there's a lot of information here, but basically on the year to date, longer term dated bonds, a 30-year bond year to date was actually down 15% from the actual value of the bond, because the yield went from 1.65 up to 2.4. What we're talking about, the 10-year bond was from about the end of the year 0.9 to 1.74 at the end of March, and that was a year-to-date price return of -7%. So in an rising interest rate environment, you want to be in shorter-term bonds because they have a less effect when rates rise. If you could look over here on the right side here, the impact of a 1% rise in interest rates, the gray is a price return and the blue is total return, because you do get some interest payments from bonds. So as you can see, a 1% rise in interest rates affect longer term bonds more negatively than shorter term bonds. So that's one thing we're keeping an eye on from an investment perspective, is keeping our duration, the length of our bonds on the shorter side of the scale. And then just diversification. There's different types of bonds, whether that's corporate bonds, bonds issued by government. They are even floating rate bonds, which means they're variable bonds. So when interest rates rise, the bond actually pays a higher rate as well. So we are, just as we diversify in the stock part of the portfolio with small companies, large companies, value companies, growth companies, etc. On the bond side of the portfolio, we diversify as well between corporate bonds, short-term bonds, long-term bonds, bonds of different quality, and that really plays into how we're developing the portfolio. And we often get asked, or we may ask ourselves, why do we want bonds at such a low interest rate? Well, if you just think back of a year ago, when something drastic happens in the market and the stock market's down 30-40%, most people's bonds portfolios were up 8%, 7%, depending on the time frame you're looking at. We're happy to go into more detail with that you individually. And really, it's a form of protection. It is a form of protection. So we have to diversify and get yield as best we can. But we really think about the bond part of the portfolio as protection against where the stock market's really chopped. Some historical numbers. Again, past performance is not a predictor of future performance, but this is actually the only 10th time since 1926 where we saw the first 3 months of the year have positive stock returns, but bonds negative. As you can see, as I was talking about earlier, stocks up about 6%, US bonds down about 3%. On average, over the 9 months for similar periods, you see that bonds kind of catch up and return 3%, and actually stocks actually continue to that longer term averages, which is around 9 to 10% a year, which is on average for US stocks over the long term on an annualized basis. So what we're saying here is, yes, we've seen some negative returns in the bond part of the portfolio, but we expect that to average out as the bonds pay interest throughout the year, and we will see where the economy actually goes for the next 9 to 12 months. Because if we do get some negative surprises in the economy, and maybe we don't grow as much as we think, interest rates are not going to continue to rise. We'll actually probably see interest rates turn over and go back down. So we'll just we'll have to maintain ourselves and maintain our portfolio, keep an eye on the stock and bond market. So going forward, points of optimism. Yes, the vaccinations are on track for 200 million shots given out in the first 100 days of the Biden administration. If we can get to some level of herd immunity, we know that COVID is not going to go away completely. There'll be different strains, but if we can get to a point where we see a lot of fatalities dramatically decrease, we're going to see a reopening of the economy that really is going to push forward the economic growth and continue to support the markets. As mentioned already, government stimulus, possibly in the form of an infrastructure plan, but also central banks around the world continue to keep interest rates low and being very supportive of the markets as we come across or come out of, hopefully, a global pandemic. And we do believe that the reopening economy will help across the globe, whether that be international markets or domestic markets. Where we might see concern, as I mentioned, new strains, folks not wanting to take the vaccination, finding out the vaccinations aren't as effective as we think they are today. So, you know, that is going to remain with us throughout the year. With all the money being printed and being potentially put out as a form of economic stimulus, inflation really hasn't shown its head so much, but we are starting to see some potential parts of inflation hitting the economy. Not necessarily a bad thing, but you definitely see it in the real estate market, at least here locally, and from what I understand, many parts of the United States where housing is at a premium. So we're seeing some inflation pressures in the housing market. And you know what, actually that's good to be in stocks in inflation, because as a company, if inflation happens and you know the materials you use to make your widgets become more expensive, you can actually just pass that on, for the most part, on to your consumers, and the company can kind of pass on some of that inflation onto the cost of the production. So you know, typically speaking, inflation is positive, or at least can be passed through stocks, real estate, hard assets such as commodities. And another point of caution, again, is different. We'll have to see what happens with the tax rates, and that could also turn into a headwind against the economy and against the stock markets, because if we have too aggressive in the form of tax increases coming out of Washington, that will potentially affect, to the negative side, the economy. So that is a quick rundown of what we have seen in the first quarter of 2021 as far as our investment and the markets, and what may lie ahead of us for the rest of the year of 2021. If anything that you've seen here today strikes a question, or you want to have additional conversation, please reach out to our team here at Tobias Financial Advisors. So we do have some folks listening today who are not clients today. We would like to remind you that we do offer a complimentary review of your financial situation, and so we'd be happy to have a conversation with you as well. With that, thank you for joining us today. It's been my pleasure to walk us through the recent market performance, and here's to wishing you a safe and hopefully a somewhat return to normalcy into 2021. And we will be back with you next quarter for another fantastic webinar. Thanks for joining us today. Take care.